Markets don't just go up or down, they rotate. Today I'll share 3 simple signals to help you pivot without the drama. We'll use one framework, 3 metrics, and a checklist to guide us. Plus, I'll give you a quick demo of our AI Portfolio Checkup to sanity check your positions before you rotate. Just a heads up, this is for educational purposes only, not investment advice. No stock tips here, just a solid process to follow. First up, watch for valuation stretch. When multiples expand faster than cash flows, we flag EV-EBIT versus the sector. If leadership trades far above its history while quality metrics stall, it's time to trim overweights, not panic sell. Next, keep an eye on earnings momentum split. When revisions turn uneven across sectors, the market usually rotates instead of crashing. We lean into ROIC strength with FCF coverage and step away from names failing 2 out of our 3 checks. Lastly, watch for liquidity and rates turning. Even small changes in long rates or credit spreads can shift leadership. We read the regime as risk on or risk off and adjust position size, not our entire philosophy. Now, let's apply our framework to rotation, core, cash flow, and guardrails. Your core should be US and EU broad ETFs, keeping it as your engine. Cash flow adds resilience. Dividends cushion volatility during a rotation. Guardrails like cash or T-bills at 5 to 10% give you dry powder for a pivot. Before rotating, test each candidate with the ROIC, FCF payout, and EV-EBIT trio. ROIC signals a durable advantage, while FCF covers payouts to avoid yield mirages. EV-EBIT keeps valuation anchored across different capital structures. If 2 out of 3 metrics fail, it's not a buy-the-dip candidate. If 2 out of 3 pass, it's eligible for measured adds. Let's talk about portfolio structure you can actually run. For an illustrative rotation tilt, keep US-EU broad exposure but trim overstretched segments. Use those points to finance adds in quality cyclicals or defensives, depending on your signals. Upgrade the quality of your dividend exposure, favor coverage over raw yield. If spreads or rates flash amber, move to the upper end of your cash/T-bills band. Before you rotate, grade what you hold and what you want to add. Risk grades combine volatility, quality, and valuation, so we don't add risk blindly. Forecast bands give you probability ranges instead of single number calls, helping you stage entries in thirds. Explain cards show why a candidate is strong, like ROIC increasing or FCF covering the dividend. What if scenarios project sector tilts and a portfolio-level Monte Carlo drawdown band? The net effect? A rotation that's planned, funded, and testable. Now let's talk about the action ladder. Pick your dose, not a drama. For a light tilt, use new cash to lean toward names that pass 2 out of 3 metrics. For a moderate approach, trim the weakest overweights and upgrade your dividend sleeve quality. In high-stress situations, raise T-bills to the upper guardrail and pause drip until spreads and volatility cool. Run the checklist before each change. Which of the 3 signals triggered you? Does the target pass ROIC, FCF, and EV-EBIT? Are your sleeves drifting plus to 5% from target? What's your entry plan, thirds and limits? And don't forget to journal the change and set the next review date. If you want less drama and more process, subscribe to Alpha Atlas. Try the AI Portfolio Checkup, link below. Download the rotation checklist and a sample CSV to test this on your portfolio today.